hosted you. Anand is Chief Investment Officer, Equity for Franklin Templeton Asset Management India. In a nutshell, Anand is responsible for overseeing all the local equity funds. I like to introduce him as the marathon man because he physically actually runs marathons, and he's had a marathon innings in the asset management industry since 1994. So welcome, Anand. Also, a warm welcome as well to Janakiraman, Deputy CIO and Senior Portfolio Manager Equities for Franklin Templeton India AMC. Welcome, Janaki. Good to see you again. You flew in this morning? Early start?
Yep.
Yeah? So you've got your own mic, Janaki. I said marathon man because I tell you, every single time I think of you running, investing, both to me very stressful activities, I get tired at the thought.
It makes you look tired all the time. So if I don't look very fresh, blame it on both investing and running.
Which, is where I'm going to take off with my very first question. Anand, 3 decades in investing. You've seen so much parivartan in India, in the economy, in the markets. I want you to sort of break it up into 3 parts. Each 10-year period, what was the biggest parivartan that you saw? And how was each decade very different from the previous one? So first, let's rewind to when you started out.
Interesting question. When I joined the industry in '94, fresh out of college. Incidentally, I got my degree from the then Finance Minister, Dr. Manmohan Singh, right after the peak of liberalization, etc. So the 90s decade, the 90 to 2000 decade was a period of very tough reforms. Lots of protectionism was there. Tariffs were cut, protectionism were let go, many industries were delicensed, foreigners were allowed to come in multiple sectors and multiple industries. As a consequence, what happened was investing became very tough. You don't know who is going to win, you don't know who is going to lose, and information was not readily available.
And the rules of the game just changed.
Everything changed.
Yeah.
And corporates were fighting it also. Nobody wanted to cede space easily. There was a Bombay club and all that stuff. You might be familiar with that term. So first 5 years was a extremely tough year, in where the corporate sector was getting used to the change, and the profits were not growing. In fact, some sectors were degrowing. Many of my friends who joined the industry along with me quietly left the industry in pursuit of happiness in other sectors, especially IT.
But you stuck around because you're the marathon man.
I was unemployable in IT, so so finance kept me. So in that sense, it was my luck. So 90s was a very tough period. Markets returns were okay. I wouldn't say they were very attractive, but the changes which was initiated in the 90s started having impacts in the 2000s, and from 2002, roughly around that time onwards, we saw really meaningful growth in sectors. New companies came in, new sectors opened up. We saw a beginning of investment in infrastructure, a golden quadrilateral. Mumbai airport got built, Delhi airports got built, Bangalore, Hyderabad, many of them followed. And I think and the party continued till 2009 through the global financial crisis. A lot of new power plants, mining, licenses were given, lots of reforms, changes. Markets were doing pretty well as well. Money making was easier. But even then, I would say, we came out of tech bubble burst and then got into this beautiful economic expansions. And that period was a period of good change. Then again, after good times came a little bit of bad times, high fiscal, high inflation, and we had tough time between 2009 to 2012, 13 kind of time period. And then again changes happened. Some of the changes are maybe linked to political change, but I would say it's also a lot of economical change. some resets happened, and we saw newer kind of reforms happening now, better governance, lots of reduction in subsidies and stuff like that. And now we are seeing India has made significant progress in terms of overall economic pillars of growth. So the decadal growth rate in the 90s was about 5.5% or so. And then in the 2000 to 2010, it was around 6.3. And 2010 to 20, it is about 7%.
So we can see the step up.
Yes. Unfortunately, because of COVID, 2020 to 30 won't beat 7. Yeah. But it's probably match up to 7.
Okay. So again, I'm going to ask you to be as honest as you possibly can. In this 30-year period that you've been investing, any mistakes that you've made, what those mistakes may have taught you, shaped you into a different kind of investor?
I mean, all of us have made mistakes. I think I have made...
Oh, he's pointing to Janaki very quickly, saying all of us have made mistakes. Let's spread it around.
The longer you are in the market, the more the mistakes you would have made. That's very simple. And the beauty of it is, without making that mistakes, you cannot become a better investor also. That's also all of us know. Many of you who are here investors would vouch that statement. There are multiple kinds of mistakes which humans are capable of doing. But my favorite mistakes are a couple of them. One mistake I say is playing relative value game. That is, you don't buy the best of the sector and you try to settle for the second best, third best, fourth best of a sector. And it's a mug's game. Normally, it doesn't give the best of the returns. So if you can convince yourselves to buy the best of the sector early on, get convinced. If he's not getting convinced, take some more time, but get convinced. Instead of settling for the second or third best. I think relative value dilutes the return over a longer period of time significantly. And for example, the best tech company, IT services company would have given manifold times better returns than the second best tech company or third best tech company. Similarly, the best private sector bank would have given manifold times better returns than the second best, third best private sector bank. So that, I think, is something I consciously try to remember it, though it's very tough to follow.
I know, I can imagine it, because, you know, as you describe it, I say, well, that's a tough one to navigate, because you're taking that call on what is going to be the best a little early on, and then not getting distracted by what is potentially second or third. Any other mistake that's taught you or stayed with you?
I will stop with one mistake. Okay, good. Otherwise, people will think I make too many mistakes.
Okay. Janaki, I'm giving you an easy one now, huh? India seems in a pretty comfortable place as far as GDP growth is concerned. You know, there is some debate on the side about the actual numbers, etc. But we'll get to the debate part later. India GDP growth seems good, especially when you look at it compared to many other parts of the world. What are the sources of resilience for the Indian economy in your analysis?
It's true, Manvi. India is in a sweet spot now. And the spot looks much sweeter when a contrast is used, when you compare the Indian situation with some of the predicament that other economies are facing. Slower growth, higher government debt, things like that. We seem to be in a much better position. Now, some of the key observations about these positions are the cyclical factors that are now strong catalysts for the next few years. All these catalysts have a profoundly domestic flavor.
Yes.
So this is not really dependent on what's going to happen in the rest of the world. If you are a Korea, if you are a Saudi Arabia, what happens in the rest of the world is of very high significance to their own growth. So to some extent, we are a bit immune to that global risk. Largely, we will make our own fortunes. Now, what are these? I've met many of the distributors for the last 1.5 years, and I've been driving home one point that after a very long time, 2 cycles have turned favorable. And in a macro growth perspective, the cyclicality in growth is brought about by these 2 factors. One is the real estate cycle, and the other is the capex cycle. We saw the best of the peaks of these cycles long time back. Real estate cycle peaked in 2013. Industrial capex peaked actually even before that. So the last 10 years has been a bit of a barren phase. Now those things have turned for the good. So which means that next 4 or 5 years we're looking at least a 6% macro growth. And that's a very powerful tailwind. That's, yeah.
So I want you to distill that macro belief that you have into certain sectors and themes which in your view present the most promising sort of long-term opportunities sitting here in September 2023.
See, earlier you asked Anand about what's happened in the last 30 years.
You don't go back 30 years. I want to know what's promising from here on, based on our steady macro picture.
If you go back to 91, it looked as if the liberalization was going to help the manufacturing much better. But actually what has happened in the last 30 years is that services has played a much more dominant role.
Yes.
Manufacturing is under fire. I think we are at a point where the scales are clearly tilting in favor of manufacturing. Domestic manufacturing has reached a level of sophistication so that now it can play a more dominant role in the economy. A classic case in point, which many of the people in the audience also will appreciate, just have a look at what is the domestic, the indigenization content in defense procurement.
In defense procurement.
Just about 10 years back, this used to be less than 50%. And now we are running at about 75–80%. Many of the complex platforms are now being manufactured within the country. Another contrast, 2003 to 2010, a fantastic capex cycle that we enjoyed, but we used to import a lot of machinery. Now, if you turn to this cycle, the ongoing capex cycle, I think this time domestic manufacturing is going to play a far more dominant role. So to answer your question, at a broader level, I think manufacturing is going to play a more influential role, and which means that for people like us, ultimately it all distills down to one question: how do we make better money? I think manufacturing is going to throw up much more opportunities.
So the message is very clear from you, and you've outlined the causes for it: import substitution, indigenous capability and capacity and focus on manufacturing. And this, given that it didn't exist during that post-liberalization, services-led expansion of the economy, this is a theme that you see playing out. And I'm going to throw in infrastructure as well into that piece. So just distill everything that you just said and take a call on your assessment, or share your assessment on private sector capex going forward.
Well, that's going to be one of the key drivers.
Yeah.
Again, after a very long time, two facilitating factors are looking in the pink of their health. A, the private sector balance sheet is in an extremely strong position. B, the bank balance sheet is also in an equally strong position. You need both of them to come together. And third, of course, is the demand part. And I think that if you're going to have a 6% macro growth for about 4 or 5 years, there is adequate demand to merit a strong capex from the private side. Keep in mind, the sectors will differ. If you go back to 2004 to 10, bulk of the capex happened in sectors like oil and gas, thermal power, and metal, typically the smokestack industries. I think this time the capex is going to be in a very different kind of sectors. Huge amount of capex is going to go into clean energy and the decarbonization efforts. This was, of course, one of the reasons why we chose clean energy and decarbonization as one of the key themes for the product that we repurposed and launched this year. So the color of the capex is going to differ, but the magnitude is going to be quite strong. And like I said, both the balance sheets, the companies as well as the banks, are in a good position to support that.
Okay. I think there's a request, perhaps because for the ends of the room, Janaki, if you keep the mic sort of
Sure.
closer to your face. We'll get the audio reaching every corner of this hall. Really interesting points that you've made out there about private sector capex. I alluded to a debate on India's growth. And the reason I said there's a debate out there, because there's one group which says, you know, India is in a steady growth path. There's another which says the bottom of the pyramid, look more closely there. If there was fundamental transformational growth that was taking place in India, you would see that parivartan, bottom of the pyramid. So those are the 2 points of views. Anand, how do you sort of slice through those 2 opposing views?
There are no opposing views in this. I feel India, as many of us would vouch, is not a homogeneous economy. We have states, I mean, the average GDP is $2,300 per capita dollar, or around that. There are states which are at 3,000, there are states which are at 1,200 or something like that. So India is a bunch of many countries. So you will have demand for semi-luxury, luxury product. Also, you will have demand for basic goods as well.
Okay.
So I think to lump the country into one homogeneous economic engine in our thinking, I think we should avoid it. This is multiple engines operating at different speeds, at different levels. If you understand that, we will be able to will be open to the idea of investing in opportunities in both ends of the spectrum. Wealth at the bottom of the pyramid, as well as opportunity to make money at the top of the pyramid. So I think that is a fundamental point which we have to understand, that even if you talk to some of the companies like Hindustan Unilever, they say India is multiple countries. So their sales and marketing strategies they follow are very different depending upon the products and the product market segments they do.
Okay, so I'm going to paraphrase very loosely here to say that you stand by the fact that India is on a steady growth path. Then my next question to you is, how are FT's equity funds positioned to capitalize on this growth in the sort of Amrit Kal period?
So I think you cannot be too defensive in your investment approach. I think one of the things that we should bet on is bet strongly on our conviction that the economic growth is going to be strong, and it will be driven by the cyclical or domestic cyclical sectors. There is no point in sitting in one defensive corner of the market where, you know, I am very happy to earn 5-7% growth, steady growth by buying toothpaste company or shampoo companies, etc. But I won't invest in companies which are making motors for railway engines or locomotives and all kinds of infrastructure spending, etc. I think you have to chase growth.
Okay.
And growth changes in line with your Parivartan theme. The contours of growth changes, and when the contours of growth changes, your investment should change, the flexibility to change your investment portfolio towards that. I am not saying you change your framework of philosophy or your approach to evaluating an idea, valuing those ideas, etc. All I am saying is look at broader set of opportunities and keeps hunting for those kind of opportunities. And I think over the last 2 or 3 years, and the thing is in 2019 itself, we sensed this change. We made the portfolios more tuned towards the cyclical domestic sectors. But unfortunately, the pandemic came and made the defensive sectors outperform the cyclical sectors, and we had pretty average performance in those years. But luckily, the thesis played out. And I think it will keep playing out for, like Janaki said, few more years. So we need to bet strongly, find more ideas where India's like indigenization of manufacturing, import substitution, infrastructure spending, housing sector, real estate revival. And there are multiple themes. And I don't think there will be dearth of ideas.
Okay, well, it's good to hear that. There won't be a dearth of ideas. Janaki, the duration of the market cycle, it seems to have sort of shortened. Can you just explain to us why this is happening? Is there something structurally changing? And what impact has it had on volatility, if it has had any impact at all?
Definitely the market cycles are getting shorter, and more importantly, events are getting priced in extremely quickly. And this is all because of instant dissemination of both information as well as views, both internet as well as social media. In fact, when you asked me that question, I thought about the contrast. History buffs in the audience will realize this. 200 years ago, when Napoleon lost the Battle of Waterloo, Rothschild in London had a 1 day's advantage of the knowledge of the outcome of the battle, and used that knowledge to obviously make big money in the London market. Look at the contrast now. A, information is available to many more people. B, not only information, it's also views that are available. So the need to process that information, that also is now being rendered irrelevant, because views themselves are available and they are influencing how investors react to those informations. So this is a fact, and you cannot do anything about that. So what do we as an investor do? I cannot compete with other investors in terms of the agility or the speed to react to short-term developments. One has to understand where one's strengths and weaknesses lie. So then you look beyond the short term. Try to look for, so the competitive advantage that we as investors, especially the Franklin investors have, is we tend to have a time frame which is a bit on the longer side. So which absorbs the short-term volatility, and if anything, try to make use of the short-term volatility in building a slightly better opportunistic portfolio.
Okay, I mean, that's wise words to reflect on, because we all, I mean, even in the news business, which I've been a part of for like 20 years, we sometimes ask ourselves, what are we doing? If everyone's getting their information and opinion on Twitter, I mean, X now as it's called, what are we doing? So we do try to look at some of the longer-term value propositions, even in my business. The other sort of change that one notices, Janki, is the fact that domestic institutional investors, they are playing, or they're becoming a counterbalance to the foreign portfolio investors. Do you expect this trend to sort of stay, increase? I'm presuming it's a good thing.
It's definitely a good thing. It's been one of the standout developments of the Indian capital markets in the last decade. I think in your conversation with Avi, you were talking about, Avi spoke about the 401k plan in US. Something like that is beginning to happen here. Keep in mind, we don't have a social safety net that's offered by the government, at least for bulk of the population. So people have to make their own savings and prepare their safety nets. That's one. What I'm also seeing is significant changes in terms of the way large amount of domestic households look at equity as an instrument. 2007, I distinctly remember, most of the investors used to, domestic investors, used to look at equity as a risky product with a lumpy return profile, appropriate on a tactical basis, definitely not on a structural basis, and consistent experience with that product was missing at that point of time. The biggest antidote to all these misconceptions has been SIP.
Yeah.
So what SIP has done is it's converted that volatility of the product into the benefit of the investor. And second is, in a society, if you see some positive successes, then others feel the need to emulate it. The process of emulating that also becomes a bit easier. So many of the successful SIP stories in the middle part of this decade, I think that catalyzed the further acceleration in that. So clearly now domestic households view equities as a more longer term product. In fact, the return expectations have now become much more realistic. through SAP, they've also seen success. So I definitely see this trend to continue. And as an investor, I also have one more wish that if more and more people become equity investors, which means that their skin in the game as far as their future economic potential is better, which may actually make governments, which may nudge the government to take more economically sensible policy decisions.
Well, I think we're going to get an opportunity to make that point at some stage tomorrow. So let's get the ball rolling tomorrow evening. I want you to come back to some of the things that we've already discussed, Anand. And you'll say, why is she asking me the same question again? But I'm not asking you the same question again. What I'm asking you is, given everything that we have just discussed in terms of India's growth, in terms of new focus areas in the Indian economy, do you see any changes in your investment philosophy? I'm not asking tactics here. I'm saying in your philosophy. And if this is an existential question, tell me to keep quiet and move on.
No, I think what is the investment philosophy we follow? That is very important for us to articulate very clearly. Any emerging market investor would like to bet on growth. We also want to buy growth-oriented businesses and companies so that the companies compound. If the businesses compound, stocks will give compounding returns and our job is relatively easier. The problem only comes that how we value it and what kind of valuation we pay for it. So I'm all for buying growth at a reasonable price, and that is how we define ourselves, GARP investors. Buy growth, pay reasonable valuation. We are not GAAP investors, growth at any price investors. We are not QAAP investors, quality at any price investors. We are GARP, QARP investors. But then that alone may not be enough.
Okay.
We got to be occasionally contrarian, because everyone broadly know these are all the growth companies, these are not growth. You got to be contrarian every now and then. You got to bet a little bit against the market. When the market is betting on FMCG, you got to buy autos. When market is betting on something else, you got to buy. A little bit contrarian you have to play, so that when in a growth market, in a growth economy, all sectors eventually come back to that growth trajectory. They may be temporarily going through that phase. You got to use that phase when market is not looking at them to occasionally bet on that. So it's a bit of GARP plus contrarian bet. We need to do it. The contrarian doesn't mean just buy beaten down or no growth companies, but growth companies temporarily going through some hiccups or challenges. That philosophy doesn't change. The economic environment changes. The growth landscape will change. Growth will migrate from one sector to another sector, or one economic pool to another economic pool, etc. But philosophy should remain reasonably stable. Second, and I also jokingly say, investors will have to decide whether they want consistent style or consistent performance.
Consistent size?
Style.
Style.
Yeah, philosophy style or consistent performance. You can't have both very easily.
I'm not sure I understand that. What do you mean?
That is, markets move in cycles. Sometimes it growth oriented, it will pay high valuation to growth. Sometimes it buys value stocks, etc. So if you are a growth investor, you will underperform when value is working. If you are a value style investor, you will underperform when market has become growth.
Okay,
you are consistent in your style, but your performance will not be consistent. So people should remember that. I think all of them know it, but it is my job to tell them that there will be cycles of performance. That is just because we have been a little more consistent in our philosophy and approach.
Okay, I asked Avi this question. I'm going to ask you as well. Your view on passive funds. Share has grown. It's grown in that relatively short period of 2019 to 2023, 6% to 16% of AUMs. So what's your view?
So bulk of this, multiple views I have. Bulk of this drive in passives is driven by government only. Because bulk of the passive money in the system is coming from EPFO.
Yeah.
And they are not from active investors. None of these financial advisors, I'm sure, are driving people towards passives. They want actives. But to that point one.
That's a very powerful point in your defense, by the way.
Second point is, whenever changes happen, active managers adjust to it. For example, a few years back, earlier we were all benchmarked towards price index, Sensex, Nifty, NSE 500, and we were comfortably outperforming. Then the regulator thought these guys are having too much of a party. Now we will make it a total return index. Many of you know, right? Total return index. Total return index is price plus dividends and everything put together. Now they say you beat it. And we all were very upset because that was giving us a 1.5% cushion to outperform price index. And we said at least our bonuses were coming reasonably okay. Now regulator is now spoiled it kind of a thing. But then now good active managers are beating the total return index also. So it took some time. But now people are beating Nifty total return index, NSE 500 total return index, etc. So active managers adapt to the changing times and try to rise up to that challenge and try to beat the benchmark. I feel that many good funds have delivered that 2% annual outperformance, and therefore we should be very confident saying that keep investing in active funds. Now, why people go to passive funds? They want to minimize the cost of paying for the passive fund, which is fun. But some people are just happy to capture the underlying asset class returns alone. If equities give 13%, I am happy capturing 13%. That itself is good enough for me. At least I know that I will capture the 13%. You guys say you are going to capture 15%. You may or you may not capture. That uncertainty they don't want to take. Now that is fine. You are still not settling for low return. You are being passive, but you are capturing the asset class return. So I am okay with that. But you simply say that cannot say that I will only invest in passive because actives won't do well. That is where I have a challenge.
Okay. And I think you've done, you put up a sort of spirited set of answers to this whole concept of passive investing. And when I asked that question, I have to admit it was a loaded question, coming your way as an active fund manager, trying to get under your skin a little bit. We're talking about disruptors here. Buzz in recent times, Anand, and it's essentially about artificial intelligence, how that's going to affect the way that humans work, maybe affect the relevance of many humans per se. How do you see AI sort of changing the role of fund managers, if at all?
So a better expert will happen in the panel soon.
I know. We're all gonna get Jonathan to answer all of that.
But my limited point I will tell you, or I will ask a counter question. If you allow a chess engine to play a human, you know who is going to win. Chess engine is going to win. If you allow a chess engine to play a chess engine, what will happen? You will have a very high quality game, apparently. I Googled and found out. You'll have a very high quality game, but 95% of the games will end in a draw. Because there is no, unless there is some flaw in that one engine and the other engine is having an edge. Okay.
So I hope everyone caught Anand's answer. He said if you have one engine play another engine, what happens? And, you know, he certainly planted that doubt in my head. Just too many draws.
Yeah. So now, if you put the same chess engines, equivalent of that in the stock market, and ask each other to play, they will deliver same return, which is index return. They are like another passive funds fighting for each other because they will quickly nullify each other's advantages very fast. So I'm not too worried by this that algorithms, AI-driven learning systems, etc., coming and significantly disrupting. But where I feel they are going to be extremely useful is that their ability to improve my knowledge and productivity. My ability to analyze ideas very rapidly and faster. I think we all need lots of help in that space. Morning I was discussing with one of them. Can I have something which read all the transcripts of all the conference calls of companies and give me the gist.
Yeah.
It's already available.
Yeah.
It's already available. If I can use that, I can listen to 10 companies' conference calls in a day within 2 hours or something like that.
Janaki, I'm putting the same tech question to you, but very different answer that I'm seeking. You know, tech will change businesses. It'll change industries. In light of that, what kind of businesses do you actually see evolving and capitalizing successfully by harnessing tech? Because that will give us a cue as to where future opportunities could lie.
Clearly, because of technology, both demand cycles and product life cycles are getting shorter. It's becoming a bit more unpredictable overall. I mean, that VUCA world is becoming very, very prominently visible. Now, as an investor, how I see the picture is, what are the kind of companies actually to avoid? So I'm using the process of elimination in answering this question. What now we look for is businesses which are heavily dependent on one line of products, which are not adequately diversified, businesses which are heavily exposed to a certain type of clientele, again, lack of diversification. These kind of businesses will be hit by periodic business challenges in increasing frequency, and one such hit may turn out to be mortal. That's one. Second is, now we increasingly look for businesses which are investing, which are prepared to invest today to seed the businesses of tomorrow. So meaning that they are willing to take upfront the costs involved in new product development, in seeding new lines of businesses, maybe adjacencies, maybe some slightly farther
So in a
away.
sense, they're willing to change before they are forced to.
Absolutely.
And you're looking for signs of that willingness, of that preparedness in advance of it.
Businesses which think that the current drivers of success will continue for the next 10 years, next 20 years, those are the areas where my red flags go up quite prominently.
Well, that's an important point. That's an important point. Well, I've always got one eye on the clock, which means that Anand, Janaki, time for sort of final thoughts, a message to all of the partners who are here at Perspectives 2023. Anand, would you like to go first?
I'm sure with the markets at all-time high, there's a lot of worries investors have. Is it the right time? Should I invest now? Should I wait? Etc., etc. There can be shorter-term optimizing opportunities. I will not talk about that. But it's very clear that India is moving towards decadal higher growth.
Okay.
The next 5 years, 10 years are going to be better than last 5 or 10 years and last 20 years. I'm extremely convinced on that, and I'm sure many of my colleagues are also convinced about that. So in effect, whatever I have invested till now is only the beginning corpus of my next 15, 20 years of actual investments, is how I look at it. I think all of you and your clients should look at it like that. It's been a very tough challenge to convince Indians to believe in India's story. Right? Foreigners have been convinced a lot before, then Indians got convinced. But now that we have been convinced, we should stay convinced. We should remain convinced, because I think all the growth engines are reasonably firing. I don't see a big challenge out there, and I'm pretty optimistic on that. That's my key message.
Okay. Janaki?
I think the one nuance that I will add to Anand's message is, clearly we are looking at a very bright decade, but in the overall investment performance, what adds that additional alpha comes from how we respond in crisis. Crisis meaning market crisis opportunities. Given the comfort that you have from the expected strength in the Indian growth for the next decade or so, I think we should be prepared to use those future market crisis opportunities in a much more bolder manner. I think that is what is going to help your customers and earn you their goodwill.
To buy on corrections very aggressively.
He's putting it simply. Well, thank you very much. Great talking to you both. Thank you, Anand. Thank you, Janki. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.